Hi, I'm Bernd Nussbaumer from macrobeat.co.uk. An interesting week is behind us and we still have non-farm payroll and ISM and average earnings to come today. The highlights of the week has definitely been the FOMC, where we did get the hawkish cut that the market did expect. And what it looks like, we did get the rate pause as well, which means we're not going to expect any rate cut at the next meeting. And Mr. Powell even managed to strike a tone in the press conference that actually seems to have really pleased almost everyone. And to the surprise of many, we've seen the stock market rally, we have seen the dollar come off, and we even have seen yields come off. I guess there was one element in his press conference that mentioned if things go bad, we're going to cut. If things go good, we're not going to hike. And it seems the market really liked that one. But besides that, we still have a few data I want to have a quick look at. And on the first slide, you're going to have the US third quarter GDP. We got a little surprise there, which we did expect a 1.6 print, and we got a 1.9, which is actually keeping the average quite neatly around 2.3% for the year, which means we can really almost allow a dip to 1.5% or 1.4 for the fourth quarter. So GDP looks not too bad. On the next slide, we're going to have the Chicago PMI, which was out yesterday. That is a complete different picture here, with weakness in almost most of the components, really, which on the flip side, we're going to have the ISM today, which have been very poor in the last few months, which may actually see a small increase. But what it highlights is that the picture about the US economy is not quite clear. So there seems definitely some weakness sneaking in. Some believe that some of the weakness in the economy has been due to the really hiking cycle from the Fed, and that now that we have stimulated it with a total of 75 basis points cut, maybe that just is enough to kind of balance things out. But, you know, we shall see. On the next slide, I would like to have a quick look at the Chinese PMI. That one still seems not to be turning around. We still see weakness in both areas, which is on the manufacturer PMI and the non-manufacturer PMI. Last night we had the Caixin PMI, which saw the strongest rise in 3 years. So even in China, we have a mixed picture of some of the data pointing towards weakness. Some subsectors seem to point out to a recovery. But all in all, I would still think global growth is still somewhat on more of wobbly footing. On the next slide, I have the dollar index. We talked about this 2 weeks ago when I highlighted the big 2-year trend line, which we finally did break. We did just hold at this 96, 97 area, and the dollar had one more try to go back into this 2-year uptrend just around the day of the Federal Reserve on Wednesday. In the meantime, we have backed off again. We're back on the way back to the sort of key support just below 97. And I still continue to believe that the dollar is in the process of forming a larger top. And a break and a close below that 96, 97 level would be the confirmation I would need in order to really call the 2-year dollar rally as over. On the flip side, we have the sterling I quickly wanted to show. I know I've gone a bit mad there on the arrows. I just wanted to highlight that is the sort of obvious first real target in the sterling reprice if we keep the sort of bullish mood for the time being. 132.5, 133 is probably where the first bigger leg of the sterling reprice is going to happen. You know, assuming that the Tories are going to win the election and we finally get this Brexit done. What will be the problem now is we have about 6 shy of 7 weeks until the election. So that means the sterling reprice is not in a hurry, and the market will start to move on the back of the polls that we start to get. The bigger the lead from the Tories, the more supportive for sterling. The more the lead shrinks between Labour and the Tories, sterling can as well again start to sell off, maybe as much as 127, 126. All in all, the market still gives it the benefit of the doubt. Sterling remains supported. As long as sterling remains supported, that means the euro will be supported and the dollar will be just a tad heavy. So I think as long as we see a positive sterling, the dollar is going to stay weak. This is it from me for this week. Bernd Nussbaumer, macrobeat.co.uk. Thanks very much indeed. Bye-bye.